Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, Zinnia wealth.com. And if it's time to talk about your retirement, go to that little gold box there that it says there on the website, Complimentary Retirement Consultation. You can click on that and you'll be on your way. All right, Sharice, a lot of us are going to retire with a 401k. It might be our biggest retirement asset. The question is, what do you do with it? How do you make it a paycheck? Well, you generally have a couple of different choices. So our list today is 3 things that you can do with your 401k at retirement. So let's kind of go through the list and the ups and downs, the pros and cons of each one.
So 3 great things to consider with your 401k at retirement. Number 1, you can leave it. But if you leave it with your employer after you leave, well, there's still going to be fees inside of it, whether you believe it or not. There's no exit strategy. The market crashes. It's not as easily accessible to grab when you need cash flow. And there's no plan. So we don't recommend leaving it because nobody's really doing a whole lot inside of it. So number 2, what to do with your 401k when you retire? Cash it out. And so I don't recommend cashing it out, because if you got $1 million 401k sitting there and you cash it out, you can say a big chunk of that is going to Uncle Sam. And then you still have to create a plan. You still need to invest it somewhere, and you got to work on the taxes because now it's in a different tax category. So what do we do about that? And number 3, roll it out of the 401k to an IRA, which is, to me, ding, 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 the number one decision of all decisions, because now you can go search for a financial advisor that you like, that can create that plan for you. You're paying them to create a plan for you. And then you can roll that 401k over to the IRA. You can keep fees down, and now you can really start to say, hey, okay, I want to put a little here, I want to put a little here, and hey, maybe we start to roll our IRAs over to a Roth. But the whole point of rolling it to an IRA first is that you don't pay the taxes on it, right? It's like, you can move it and roll it. If you leave it, you don't pay the taxes on it, but you don't get anything else. If you cash it out, you got to pay all the taxes on it, and then you still got to figure out a plan. So number 3 is clearly the best strategy. Roll it to an IRA, interview a couple of advisors that understand retirement planning, not just wealth managing, and then start to consider how much of this do we roll from an IRA to a Roth so we can get potentially into a lower tax bracket later. What kind of investments? We need our bucket of confidence investments, and we need our bucket of hope investments. Our here money now we're going to live on, and our later on money we're going to live on, and our legacy plan. So these are the 3 strategies when it comes to deciding what to do with your 401k. And you can pick any one of them. Just make sure you pick the right one, the right door, everyone.
Well, one of the things that I got out of what you just said there is many people will use this term. I have a 401k plan. And that to me implies that it's a lot more than what it is. A 401k is a place to put money. It's a place, hopefully, to grow your money. But that's really it.
Yes. It's not a plan.
It's not a plan. It's not a 401. A 401k is part of a plan. It's part of your retirement plan. It is not the plan altogether, because when we talk about the 3 things that you need, protection, income, growth, a 401k doesn't do all that, especially income, does it?
It doesn't. And some 401ks, if you want monthly checks, they're not going to send you a check every month.
No, they're not.
Right? So that's not much of a spending plan. They're not going to talk to you about what is a spending plan. How do we protect us from inflation? How do we make sure that income check goes up every year? So leaving it at 401k is not the answer. And I get a lot of people, Randy, that love their TSPs. People have 401ks, 403bs, TIAA-CREFs. They're like ready to move it. But these TSP clients, they swear to it like it's the Bible of financial planning. You get these funds, but eventually you are going to make mistakes. It's not easy to get the funds. And I know they're adding more funds for you to choose from, but that is not a plan. So you really got to really think about, okay, I did this before I retired. Why should I be doing this in retirement? It's just like when you age into Medicare, you have an employer plan and you have the option to come over to Medicare and get a plan and a private plan there. And do you do it? And 9 out of 10 times it makes sense to leave your employer plan health insurance and go to these Medicare supplements, because people can save $100, a month, $200 a month. I've seen people save $800 a month by doing it. So you just got to investigate, look at the options, and not set it and forget it and think because it's done well for you during your accumulation phase of your life that it's going to be doing just as good for you during your decumulation phase of life when you're pulling money out.
So when you look at somebody across the table and say, Sharice, I really it's been good to me, this plan that I've got with my employer, my money's been going up, I kind of like this, and they're not thinking about fees. Do you find that the employer plans have higher fees and you can do something about those fees if you roll to a personal IRA? Can you get down to lower fees?
Absolutely. So let's say you're going to go alone. You're not going to move your money to a financial advisor. If you have a fund at a 401k, let's say you have a target retirement date 2020 because you're retiring. I almost guarantee that 2020 retirement target date fund, if you leave it there for the next 10 years and just let it sit there, you're going to be paying more in fees than just coming over and move it over to Fidelity and a cash account getting 4%, and or just shoving it into a S&P 500 iShares exchange traded fund. I know for a fact you're going to pay less by doing that. So why would you leave it back there? And I just say it's laziness, or you're afraid of advisors, or you've heard bad news and you don't trust anyone. But don't manage your own money in retirement. That could be a really big hazard and mistake. That could cost you millions, hundreds of thousands by one mistake, a tax mistake, an investment mistake, just a not knowing mistake, a stressful mistake, right? Just having somebody to rub shoulders with, have ideas, come to and complain every year, or come to, hey, I want to spend more money every year. How do I do it without running out of money? Like having that conversation. I do believe finding the right advisor, the best fit for you. It doesn't have to be Zinnia Wealth Management. Yeah, we want you to come see us. But if you don't like us, find somebody else that does stuff like us that you can relate to, because I really feel like somebody in your life, it's very valuable. And then if you pass away and you have a surviving spouse that doesn't take care of this stuff, to leave that burden to your surviving spouse without them really knowing the plan, it's just not a good way to go and enter retirement or leave retirement.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.